Hi everyone, welcome back to the channel. In today's video I would like to talk to you about the stocks, why they matter, how they work, also about their impact in the global economy. In particular, I believe as the business analyst who is working in the banking industry, it's so important and crucial to understand how financial instruments work. So today we will dive into particular topics which is equity in stocks. And if you're new here, I'm business analyst, I'm working in investment banking, and I'm also MBA and CQA qualified. So what are the equities? Equities represent stocks or share which can be also considered as the ownership of the particular company. When you buy equity, you own slice of the company, and this ownership will give you a right for profits through the dividends and voting rights through the shareholders meetings. There is two types of the stocks. We have common and we have preferred. So the common shareholders, they will have a right for voting, and preferred shareholders, they will receive their fixed dividends, but they might not have right for voting. Let's look at the equities in the broader financial system. When companies selling shares or the equities, it means they want to raise the capital and the money later that they can use for expanding their operation, maybe investing in a new project or hiring new people in order to develop some new products. So here we can say that stock market helps company and businesses to grow. Other things to mention that investors who usually include people, institutions, funds, so they buy stocks in order to gain returns, which usually comes from dividends, which is the cash payouts, and stock price increases, which is the capital gain. And of course, equities reflect the economy in general, because of when people expect the economy to grow, then stock prices, they usually will go up. And when there is uncertainties, then usually stock prices, they tend to go down. So here we can see the stock market can act very often like the economic thermometer. Let's look what are the stock markets and exchanges. So we can say stock exchange is like a marketplace where people buy and selling stocks or shares. So what's happening here? The people who want to buy shares, they will go to exchange, and the same applies for the people who want to sell, they will go to the same place. So the stock exchange match them is like any store matching buyers or sellers. And it's so important because of it makes selling and buying fast, easy and fair. And this is called liquidity, which means that you can buy or sell at any time you want, and also you will get the price which reflect the current supply and demand. Here are some examples of the stock exchanges. We have New York Stock Exchange, home of tech stock like an Apple and Google, and of course London Stock Exchange. And it's so important that exchanges also enforce listing requirements, financial disclose, governance standards, and minimum market capitalization to protect investors. Let's move on to equity evaluation. Before we go into the deep calculation, I would like to raise here the importance of the time value of money, because going further we will have to discount our future profits. So why we are doing this? Firstly, because of $1 that you are owing today, it worth much more than the dollar you will own tomorrow. One of the main reasons of that is because of inflation reduce value of money over the time. And also important to mention that future is always uncertain and there is always this risk of not getting paid. And this is called value of money. So first, let's use this formula to calculate the present value or PV of the future cash flow. So first we can see, so basically PV is the money that was today. My future cash flow, it will be money that we expect to receive. Then of course we will need by discount rate, or it's basically your required return. For example, here in this cases I'm using 10%. And then we also need numbers of years in the future. So by applying this formula, basically on the first year, my present value will be equal 4.5. Second year, it will be 4.13. And the third year, we will have $3.76. So my total present value will be $12.44. Another important step to mention here that also we need to add terminal value, or also it's called long-term value. So most companies, they will continue to earn money beyond 3 to 5 years. So we estimate the value of those future profits using the Gordon Growth model, which is also very simple, where terminal value can be derived from the following formula. So here we will have last year of cash flow, then we need to get my long-term growth rate. For example, here I'm using 3%, and then of course discounting rate, which was 10% from the previous example. So my terminal value, basically we can receive of approximately $73.57, and if we will have to discount it back to today, so my present value of that terminal value will be approximately $55.26. So now let's total all of them. So in the total value of the stock, we have PV of the cash flow that we calculated before of the $12.44, and PV of the terminal value that we just calculated of $55.26. And as you can see, the total value of stock will be approximately $68. So briefly here about the risk and rewards of equity investing. Equity investing offers potentially higher returns, but behind there is always significant and a high risk, because of stock prices are always very volatile, as they are driven by geopolitical events, interest rate, company performance. Risk can manage through diversification, but it cannot be eliminated. That's why equity market is reward risk takers. So as we had seen today, equities can be a dynamic intersection of finance, strategy, economy, and psychology. And if you enjoyed this video, you might also like this one, and please don't forget to subscribe if you haven't yet. And thank you very much for watching me, and see you in the next video.